TVS presents the Realty Debate, powered by Tata Capital, with Manisha Natarajan.
When private equity investments in a sector going through the churn of the mill shoots up 170%, it beckons the big question: what is it that PE investors see in India's real estate sector? What's driving the big-ticket investments from global names as marquee as Warburg Pincus, Temasek and Blackstone? Is it distress and bargains that's driving these deals, or is there a long-term growth story in India's property markets which the retail investor seems to be missing out on? Joining me today on the Realty Debate to get the answer to that question, Raj Menda, Corporate Chairman, RMZ Corp; Rajiv Sabharwal, Executive Director, ICICI Bank; Khushru Jijna, CEO, Piramal Asset Management; Amit Goenka, MD and CEO, Nisus Finance; and Ritesh Vora, Partner Real Estate, IDFC Alternatives. Before we start this discussion, consider this. Private equity inflows into Indian real estate are at their highest in 4 years. PE funds have invested over 11,000 crore rupees, that's $1.6 billion, in the country's commercial and residential real estate in the first half of 2015. That's up a whopping 170%. It was 4,000 crore or $0.6 billion a year ago. The top 5 deals of 2015 will come up on your screen, but let me first tell you what are the big 5 questions we will seek an answer to. Number 1, what really is the color of the money coming through or coming from PE investors into India's real estate? Is it debt? Is it equity? And at what cost? What kind of developers and projects are getting the money? Question number 2, are PE investors truly the knight in shining armor for an industry faced with its back against a wall, with slowing sales and capped bank funding? Question 3, is there a longer term story or confidence in India and its superstar Prime Minister, Mr. Modi, which is driving these big bets? Or are most of them making just hay when the sun shines? Is it bargains on the table? And finally, is the retail investor worried too much about India's property market and missing an opportunity? Or is he or she right in their wait and watch approach? So 5 big questions, and let me start with Raj Menda. Raj, from a developer's point of view, tell me what's really going on. I mean, PE investments at a 4.5-year high. What is the color of the money which is coming in?
So, I can start with just sharing my own company's experience. I think we've had a long haul of different PE investors coming through the door, and we're lucky to have the biggest and the best in the world, most of them being sovereign backed. And importantly, I think most of them have a focus on real estate. And this point I will enumerate a little later in your debate as to why the focus on real estate and those PE funds should have an experience in the real estate. But the good part is, because these are sovereign, I think it's a long-term play money which is coming in, and which is the question you're asking. And the payback starts anywhere after 7 years and beyond. And some of them just on for the record say 7 years, but they also do inform us that because the kind of investments we make are on long term and have a high capital appreciation going forward, they are in really no hurry to take back the money, as long as we can satisfy them that on an ongoing basis the capital gives a very fair return on their equity invested with us.
Okay, so long-term money seeking a reasonably good capital appreciation. Khushru Jijna, is that the color of the money which is coming in? What we hear is that there are lots of conditions being put. Maybe Mr. Raj Menda's business might be one of those rare ones where PE investors are chasing to get into it. But overall, if you give me an industry view, what sort of money is coming in and at what conditions and terms?
No, so in fact, I would agree with Mr. Raj Menda. In the last, we have been seeing this thing happening from the last, I would say, October onwards. But the color of the money and the players have changed. If you really take a step back, in 2005, 2006, there were a lot of LPs which were coming from overseas. But now the people who are coming are really, really long-term players. They are basically sovereign funds, pension funds, and which is very good for the industry, because if you really, one of the reasons why the PE industry also failed, there are several reasons for it. One of the reasons is, which I always say, is the 7-year window for a real estate project in India, especially FDI projects, large projects, is not sufficient. You really need 8 to 10-year money, which can be brought by sovereign funds and pension funds. I do not think there are any conditions attached. I think it's the same. It's more partnership than the LP-GP relationship.
All right. Ritesh, would you agree with that? Because the last time we spoke, you said very little is equity, most of it is debt, and there are lots of conditions. The risk-taking ability of PE investors in the current market is much lower than what you would have seen in 2005 and 6. So do you call it being circumspect and more rational and balanced? Or are you saying that, look, there's so much desperation out there that you can call the shots?
Yeah, so I would say that, it's the case of once bitten, twice shy. What really has happened is that, we've now seen almost about 10 years of real estate investing in India, whether foreign money or domestic money in an institutional form. And that, capital cycle has seen its own highs and lows, 2005 to 2008 being the period of high, and then subsequently a low down, and then again, about 2010 to 2013 when the markets were doing better, were periods where funds were also doing better. So I think, on an overall basis, if you see, as I keep repeating, in the early phase of investing in India, 2005 to 2008, there was a lot of focus on returns. I think this time around, there is a far greater focus on risks. So you are seeing much more intelligent money, much more thought through money, money which now sees what the market has been, what developers have been like, how the policymakers, how the government has behaved in the last 10 years. And it's coming in with all of those things already, keeping that in mind. And that is what is really driving the sort of money that's coming in this time around. I think there is a lot more concentration. So there are very few LPs who are taking very large bets. Unlike the last time around when you had a lot of smaller LPs, writing $10, $20 million checks. I think this time around it's the long-term patient capital which is looking at India from a longer-term perspective that is coming in. The numbers might be few, but the deal sizes are much larger. And equally, I think on the other side, the recipients of this capital, again, I think there is a concentrated list of developers who are likely to receive capital this time around. And these are developers who've shown performance, track record, behaved well with investors in the past. So I think it's a very, very different market compared to what we saw about 8, 9 years ago.
All right. Rajiv Savarwal, would you agree that it's a very different kind of market from a banker's perspective? Are you thinking that there is a missed opportunity here because you really have a limit of 15% in terms of total exposure to real estate, and here you have PE investors who are getting into it with long-term patient capital? Do you think these limits be changed, or do you think within the ICICI group you do have a PE fund dedicated to real estate, so let them actually go out there and invest aggressively?
So we at the bank are largely focusing on debt, and that's our strategy, and we will continue on that strategy. I would agree that the way things were in the past, it has changed now. In the past, we were seeing blind pools of capital wherein names were being backed without projects being identified. I think so that has changed. Today, money is going into specific projects, and it's true that it is coming through large sovereign funds or pension funds, and it is going to specific developers. Another thing, which we should remember at this point of time is this, that we are in a scenario wherein we are seeing real estate prices at a much lower level than they were in the past. Two, we are also in a situation where interest rates are coming down. I think so both of these offer an excellent recipe for equity investors to come in. During the last few years, when this was not true and interest rates were not expected to come down so sharply, or the fact that real estate prices were not so soft, everybody focused on creating debt-like structures rather than taking equity positions. Now, when situation has changed, we are seeing more money coming in towards equity, and we feel which is the right thing for the Indian market because that is what will actually propel growth too.
Amit Goenka, would you agree with that? Because as far as I know that yes, you have PE investments at a 4-year high, but most of it seems to be more structured debt. Rajiv Sabharwal just mentioned that slowly you can see that color of money changing. There is equity, and of course all our panelists have said that this is very different from 2005 and 6 because it is really long-term capital from large sovereign funds. So there has been a very big shift in the kind of PE monies coming into India. But my question is it structured debt or is it becoming increasingly equity? And going forward, how will it be?
Yes, I would agree to some extent with that view. As I had estimated about bulk of the equity money that has come in has gone into core and core plus assets for the purpose of buying ready commercial buildings, and a very small sliver of equity has really gone in. A bulk of these commitments are largely towards affordable housing platforms. But if you look at the massing of the capital, which is away from these very, very specific or niche deals, really still continues to have the flavor of debt or mezzanine structures. And I think that will continue for quite some time, at least for the next 1 odd year. Clearly, having said that, the impact of the interest rate reduction and the gradual lowering of the yield will impact, therefore, the overall returns of debt funds who will be forced to look into more equity-linked structures. But whether pure risk appetite is going to walk into the country, I don't think so in the near future yet.
Okay. Kushu, Jijna, just help us understand, you know, what I'm hearing is that also money is chasing a handful of developers and large projects. So does that not mean that the pie is not that big, or am I estimating wrong? The pie is really big out there?
So let me answer this in parts. Actually, what Amit said is right. So let's take a step back. If I may just take a minute. You know, let's start from 2005, 2006. A lot of money came in. We just discussed that. I don't want to go into the color of the money. Then most of the people lost the money for various reasons, Lehman being one of them, but there were various other reasons which are internal to India and also internal to the non-understanding of the real estate market as far as the PE investors go. What happened a year ago was that the PE investors just disappeared. After that, there were a lot of projects which got stuck for the last mile funding, etc. So whether it was the NBFC or whether it was the private equity, domestic players, especially like us, we were really doing structured deals. It's right. We were actually doing debt-like structures. I can say this with confidence because, as you are aware, right from pure equity to preferred equity to structured debt to construction finance, we play the entire capital stack. But however, from October, we started seeing a change. The change came because of the optimism which started with a few developers who started looking at land parcels, whether it was new parcels from landlords or whether it was from the distressed developers. And that is why today, to answer your question, what is happening is there's actually consolidation actually started which is happening. What it means is that there are strong players which are becoming stronger, and there are players who are deep down in debt, who are distressed, who are actually selling out or doing JDAs. Okay. Fund houses like us, and let me qualify, when I say fund houses, we do everything as I explained. We are, yes, like others, are backing the strong developers. Okay. So yes, there is a lot of money, whether it is from outside or from India, which is basically backing the top developers to consolidate.
All right. So I've also heard that, you know, out of 1,000 plus developers in Mumbai, you probably by the end of the cycle see maybe 500 surviving. Half are going to disappear in this slowdown, but that could be an opportunity. I think let's move on to the next big question, and this only Raj Menda can answer. Mr. Menda, are PE investors today truly the knight in shining armor for an industry which is faced with so many odds and slowing sales? I mean, take commercial, take residential, and give me an answer on that question. Are they the knight in shining armor or not?
See, the question is, I've always looked at PE as, you know, a source of, huge capital, and it's only scratching the surface in India. So, and in terms of the, as to, is it a knight in shining armor? Yes, every developer would like to maximize his potential beyond his own capital and even, be able to multiply capital on behalf of the PE investors. So the question is, can we be satisfied with the kind of money being thrown into the country? I think even if you give 100 times more amount of money to reputed developers, they know how to multiply it because they have the skill, but don't have inherently their own capital to grow the business. And the amount of money, like I said earlier, that has come to India is just scratching the surface. India can just absorb so much more PE capital, both on the commercial side and on the residential side. The commercial side creates the infrastructure, and for that infrastructure, the residential side creates a home. So, they complement each other. So, PE investment is required on both fronts.
All right, so he's saying that there's a lot more money which can be absorbed by the Indian real estate market. Okay, gentlemen, we're going to take a quick short break, but we do have the other two questions which I posed right at the beginning. Is there a longer term story or confidence in India? And of course, all that this government is doing, which is driving these big bets, long-term bets. And finally, is a retail investor missing out a little bit on India's property market? Why are they missing the opportunity? Why are they not being able to get good deals if PE investors are? We'll come back and we'll continue the discussion. Stay with us.